Hey everyone, welcome back to another episode of my M1 Finance portfolio series where I'm attempting to reach a $100,000 portfolio in this platform M1 Finance. We're over the halfway mark at about $56,000 if you include my cash balance, and we've made steady progress through the last year and a half. But this relatively short journey has not been without mistakes, and I want to highlight that here today. But before I get into that, just want to remind you that if you want to take a look at all of my holdings in this portfolio specifically, I always include a link in the description below and also a link to sign up for M1 Finance, this platform. It's free to open up an account and it has a number of nice features that I've highlighted in the past, including auto investing, which I actually have off right now, really cheap margin loans as well if you want to leverage your portfolio to use the money for something else or even double down on your own portfolio. Lots of little tools you can use here. It's not without its drawbacks, of course, but I have a very detailed breakdown of all the features and have some tutorials that you can reference that I always include in the description. And of course, if you do sign up for M1 Finance using the link below, then I might get a small commission once you fund your account, which would be fantastic, and I'd very much appreciate that, and you should get a great brokerage out of it as well. But the big change I'm making to this portfolio right now, which will actually go through at the next trading window when the market opens tomorrow. I'm filming this on the evening of the 14th, and I always put out a new episode on the 15th. So anyways, what's going to happen is I'm removing this Chamath SPACs slice, which is two of his SPACs, Chamath Palihapitiya, the master salesman and SPAC master, I suppose would be a good name for him, and I'm replacing it with this ETF here, the Global X S&P 500 Covered Call ETF. I'll explain more about that in a little bit. I see this as sort of a bond alternative in this very low interest rate environment, low yield environment. But anyways, about Chamath SPACs, that's where I think one of the biggest mistakes in this portfolio has been. And you can't see it now because I've removed it from the portfolio, but I'm down something like 30 or 35% on this position. So I think I put in about $2,000 and it's down to 13 or 1400 or so. And that's not the reason it's the worst investment I've made. It's not just because it went down. Stocks go up and down all the time. Even if it is a relatively good investment or it really fits whatever I'm trying to invest in, the stock can still go down in the short term. That's not the reason that this was bad. The reason this was bad is, sure, it did go down, but it's really because it did not really fit what I was trying to invest in this portfolio. For those of you who've been following the series for some time now, you'll know that I've gone through a bit of an adaptation, and this portfolio has changed over time. Mainly, it's switched to much more of a value-focused portfolio, value strategy, where I'm trying to find companies below what I think their intrinsic value is. This portfolio is not made for taking advantage of short-term swings or things just based completely on hype rather than any sort of fundamentals. That is not the focus of this portfolio. The two biggest components are this value slice and the metals slice. The value slice, these are my high conviction bets. This is 5 stocks that make up over half my portfolio now. This, for a while, was about a quarter of my portfolio, and I've added stocks to this. It wasn't always these 5. But as I've mentioned in previous episodes, my goal is to make this slice the biggest slice, the one with my highest conviction bets that I try to understand the best compared to all of my other holdings. I want to make sure I know what I'm buying as much as I can at least, and that I'm comfortable owning it at whatever the price it is, and I think it has good upside for the future. That's my goal with this slice. But the other big one is metals. Now, this is more of an intermediate term sort of place to park cash. It's not really going for massive growth. It's not really going for any sort of swing trades. It's more to protect against inflation. It's arguably more conservative. However, there are some speculative holdings here, mainly these gold miner ETFs that are trying to be sort of a leveraged play on gold in general, but I also have some other commodities in here, copper miners, uranium miners, and then silver as well. So this is really trying to ride some of the inflation wave and protect my purchasing power so that when I do find another value play, or if I have a real estate deal I want to invest in or something like that, outside of M1 of course, then I can move that money from this slice into that. And that would be if I didn't have any other cash to throw in, or if there was just something that was such high conviction that it made sense to sell this off and pay taxes on these gains and move it into somewhere else. And that currently makes up a little less than a third of the portfolio. So 80% of the portfolio is in 2 slices, the value slice and the metal slice. But a couple months ago during the SPAC craze, I thought I'd get cute and start buying Chamath Palihapitiya SPACs. I bought 2 of them that hadn't identified targets yet. And for some reason, I thought I could just buy this SPAC and then I'll sell it as soon as it picks a target once it pops in price, because that's always going to happen. It's a guarantee. That's kind of the thinking I had. It seemed like a very low downside play, but I completely ignored the fact that they were trading for for well above their cash value. So of course, when SPACs started compressing quite a bit, and he had all this regulatory risk from the SEC that are starting to crack down on these SPACs, and that's still kind of an open issue. But pretty much the price of all SPACs, not just Chamath's, and even ones that had actually picked targets already. And a SPAC, for those of you who aren't familiar, is a special purpose acquisition company. It's basically a company that is only cash. It takes itself public to reduce some of the regulatory burden with a company that it eventually merges with, and it tries to merge with a private company. So that's the way for the private company to go public. And the whole idea is that it saves a lot of regulatory burden for the private company rather than having to actually go through the IPO process itself. The SPAC has already done it for it. That's the thinking. And obviously that kind of tries to circumnavigate the current regulatory system. I've talked about that in other videos, but that's what a SPAC is. So I thought because it's a cash vehicle, there shouldn't be a lot of downside. But if you're paying well above cash value, which I did in this case, then you don't really have that much insulation. Then there's no guarantee it's going to stay at that value. And sure enough, it came crashing down closer to cash value. And it just doesn't seem to make sense given what I'm trying to do. And even when it does pick a target, there's no guarantee it's going to be something I like. I actually kind of doubt it would be something I'd like, since Chamath is just cranking out these SPACs. He wants to get as many of these as possible. We can see this article right here. Chamath Palihapitiya files for 4 new SPACs. He already has like 6 or something like that. So he just keeps raising money for these SPACs because it is very lucrative for him. He has a lot of incentive to find deals because there is a lot in it for him when he gets through these deals. So the incentives might not necessarily be aligned. Obviously, you can make your own judgment there. I'm not saying that it's a bad or a good idea, but for my personal investing strategy, it doesn't make sense. And I'm not really sure why I did it. Maybe it was FOMO. I don't know what exactly it was, but it just did not make sense with my overall strategy, yet I went through with it anyways. And the lesson learned here is that I really should not mess around with things that I don't understand or that simply don't make sense for my overall investing strategy. And if they don't make sense, I should move away from them or at least try to study them to make sure that it is actually what I think it is. In my case, I thought I was getting something that had limited downside when in fact it actually had pretty significant downside, about 30% as of today. So that was not what I was going for there, and I realized I had made a mistake. So I decided to just cut my losses there. Thankfully, it was a small portion of the portfolio, relatively speaking, but I mean, I lost $600 on that, and that's no fun. So that certainly was not the goal. But again, it's not because I lost money. It's because this does not make sense for my portfolio, and I don't think it's a good investment for my particular goals. But the goal of those SPAC holdings for my portfolio was to have something that was sort of a bond alternative, something that had some upside, but very limited downside because of all the cash value. That was my thinking. Again, that was flawed. So I'm replacing it with something else that probably fits that objective a little bit better, but it probably is a little bit more risky at the same time. And that's this Covered Call ETF. It's a very interesting product that Karan Gurnani actually introduced me to. Go check out his channel if you haven't already. But it's an S&P 500 Covered Call ETF. There's also one for the NASDAQ, and I think there's quite a few others as well. What a covered call is when an investor takes their actual shares, their underlying shares, in this case, say you have a bunch of shares of the S&P 500 or SPY or something like that, you would then sell an option. You would sell a call above the price that it's currently trading at. So what that would mean is that you're selling an option based on your underlying share value. And if the stock doesn't reach that call price, then you get to keep all of the option premium, it's called, because the option would expire worthless. And you sold that option, so you get the cash right away. So it's generating income when you're doing that. I don't want to get too in depth with how options work here, but the general premise with the covered call is that you're able to generate income on your overarching portfolio without actually needing to sell the underlying stock, unless, of course, when you sell that option and it actually reaches the strike price that you're selling at. So let's say the S&P is at, I don't know, what is it at, like 415 right now. We'll say it's at around $400, just to keep it a round number. If you sell a strike for $400, but the S&P is currently trading at $395, then if the S&P gets up to $400 at some point, the person who bought your option that you sold to them, they can exercise that option and can force you to sell your shares at the $400 strike price. So in other words, to make the most amount of money with a covered call ETF, you'd want the stock to reach just under the actual strike price that you sold at, because that would mean the option is still worthless, so you keep all the premium and you're not forced to sell the underlying holding. So that's how a covered call works. So it's a way to generate income. If the stock goes down, you still get to keep that income that you sold the options for. They're going to expire worthless because now it's well below whatever the strike price was. So it limits quite a bit of your downside there. Ultimately, you are buying the S&P in this case. I'm buying shares of the S&P 500 500. And on top of that, this fund is automatically rolling over new covered calls above whatever the current price of the S&P is. And the goal that this ETF has is to actually have about an 8 to 10% yield every single year. So you're actually just receiving that in dividends or the income from the covered calls. So really what you're doing is you're getting the market returns in a different way. You're getting them via income. Now that limits your downside, like I said, because you're still getting that income no matter what. But it also limits your upside because, again, if it hits that strike price, you can't get any of the extra gains that the S&P would have had in the meantime. So it's risk-reward really at its finest. You've lowered your risk for losing as much money because you're actually taking income right away, but you've also reduced your opportunity to make greater gains if we get a market spike. So really, a covered call ETF is probably one of the best investments in a market where you might think something's going to go sideways or slightly down or something like that. But I think this makes a little bit more sense for my portfolio for what I was trying to do as a sort of bond/cash alternative as opposed to the Chamath SPACs. So that is the position I'm switching into. It still is going to be a pretty small position. Maybe I'll add more money to this if I don't know where else to put it, if I don't have any other great opportunities, because I have plenty of gold holdings. I really don't want much more of that. And if we're going to get a bunch of market appreciation, at least I can ride this up, even though it would more or less fix my upside on whatever the yield is for the covered calls. So that's pretty much it. In sum, the Chamath SPAC position I think was pretty dumb on my part. It does not make sense for my strategy. I overpaid for it, and I'm just cutting my losses at this point. Even if it does pop again, I'd get back to maybe break even. I'd rather just start making some income now by buying the ETF for the covered call ETF for the S&P 500. It seems to make a little bit more sense. And if I like that position and want to grow it, I can do that. And of course, I could always buy back into the SPACs if I really want to. But I think given the regulatory risk that they're facing right now, it just doesn't really seem worth it anymore to hold that position, because I don't think it was really worth it in the first place. I was mistaken in actually making that investment in hindsight. Anyways, that's all I've got for today. So if you like this video, please like it, since that would help the channel out a lot. And if you like this series and want to see more of it, I put out a new episode every single month on the 15th of the month where I show any updates to the portfolio. And you can always copy that episode's portfolio in the description below. Not financial advice by any means. Maybe if you want to adjust it, you can use it as a start perhaps. Whatever you want to do with it, or maybe you just want to take a close look at all the holdings in the portfolio, that'll always be there in the description. And if you want to learn more about this brokerage, M1 Finance, definitely check out my tutorial series that I mentioned earlier. That is in the description as well. But until next time, take care.